For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
And welcome back to the program. Johnny Dean, your podcast host here. It is Managing Your Financial Future. We thank you for joining us. Happy to have everybody here, and I'm especially happy to have Professor Rick Plum, Certified Financial Planner Professional, here with me, because otherwise, Professor Plum, I'm just going to be talking to myself.
And that's just not any fun.
That's just not any fun. I've done that before. Not on this podcast, but I've done this on other podcasts. I've had to do talk shows on real radio years ago. And, you know, if you're used to an audience, it can be kind of unnerving. So at least we have us here.
I did that once where the whole idea was to get calls in and answer questions. And there was some problem with the phones, and so no calls could come in. And I was supposed to have a co-host with me who had prepared some things to talk. I had not prepared. And she was calling it in, and she couldn't call in either. So I had an hour of time to fill with nobody to talk to directly.
That's the disc jockey's nightmare right there.
It
Those
wasn't
recurring
fun, actually.
No, it's not fun. But hey, we've got you and me today, and we've got a whole bunch of people listening, and we're thankful for you folks tuning in, as we hope you do every single week. Don't forget, you can subscribe to this podcast, Apple Podcasts or Spotify. We hope you do that and make sure every episode is downloaded to your device. Because otherwise, even though Professor Plum and I are talking to each other, we're kind of just talking to ourselves if nobody wants to listen. But that's certainly not the case. Hey, today, I want to, a few weeks ago, maybe a little longer, 5-6 weeks ago, whatever. I think it was mid-January. We did an episode about how different types of retirement income are taxed, things like Social Security and all that other stuff. And this brought up a question from somebody who had just heard this. We get these emails generally 3 or 4 weeks after we record them. So there is a slight delay because the recording happens, a few weeks after the airing happens a few weeks after we record. Nonetheless, they asked us about this, whether or not we believe most people are going to be in a lower tax bracket when they retire, or are they going to be in a higher tax bracket? In other words, how do you prepare? What do you have to do? It would seem on the surface, Professor Plum, that if you stop working, you don't have a paycheck anymore, and you're not paying your FICA taxes and your Medicare taxes or whatever, and that all that stops, that you would tend to be in a lower tax bracket. Now, what has been, let's start with that question, and we'll work from there, the different things we're going to get into. But what has been your experience, and I'm talking about in general, with regards to tax brackets in retirement?
I would say that in general, most people are in a lower, not low necessarily, but a lower bracket in retirement than they were working. But that may be like 55, 60%, not 95% of the people. There's still a lot of people who are actually in a higher bracket when they retire because they've got great pensions and they've saved diligently and they've done well. And they end up with more income from a taxable standpoint and no deductions when they retire. So they're in a high, some people are in a higher tax bracket, but I'd still say that the majority are in a lower, but it's not uncommon, not uncommon at all to have to deal with. And that's where then it becomes, okay, how much can we take advantage of Roth conversions going forward? A lot of times I'll meet with somebody and say, okay, we're going to look at start doing Roth conversions up to X amount of dollars to take advantage of the current tax bracket and not trigger IRMA. And they're saying, well, I can't do conversions because I'm retired. Well, no, you can do conversions whenever. There aren't any restrictions other than you cannot convert a required minimum distribution. There's no restrictions on conversions with age, work. You don't have to have any of that to be able to convert. You do to contribute. You have to have earned income to contribute. But these all come into play after the fact. And so it's one of those things that gets used after retirement. And if we're going to be in that bracket, especially as a married couple, we're going to be, let's say we're in the 22% bracket, but we got another 40, 50, 60,000 a room in the 20% bracket before IRMA kicks in. And we're never going to not be in that bracket unless Congress gets rid of taxes, hey, who knows? And or they change the tax brackets dramatically to the low side. I mean, I would love to see it, but I don't. I just can't imagine it. We're going to be in that bracket. Let's use it up because the survivor is going to be in a higher bracket. So let's take advantage of what we have while we have it. Now, some people are right at the top of the bracket. They don't have any room. There's nothing else they can do.
Well, okay. I mean, when we say higher or lower, you could wind up in the same bracket naturally.
Yes, very
and
much.
Maybe quite a few people do wind up being in the same bracket. Not necessarily a lower one, but not necessarily a higher one either. So let's run down for just a bit, as maybe slightly obvious as this might seem, but let's run down just a little bit what sort of, even though you don't have let's say a W-2 type earnings situation because your job is you're no longer doing your job, but the income. Now, many people, if not most, who have a 401k and are contributing to it, I think in that situation, much, if not most, of their non-Social Security retirement income is going to come from a tax-deferred retirement account, like a 401k.
Right. It's either coming from pension or it's coming from IRA 401k distributions.
Yes.
That's the most common. There are a few people that have very large Roth IRAs where they're getting great tax-free income, but that's not the big majority. That's not even a big minority. That's a very small minority of people that have that option or have that availability. Most people, they're either getting it from pensions, they're getting it from IRA, taxable IRA 401k distributions, and the Social Security. And those pensions and the IRA 401k distributions make the Social Security taxable.
Well, yes, and we'll get into the Social Security portion in just a little bit. But if you've got income from your 401k, tax-deferred accounts, 403b, 457, thrift savings plan, whatever it happens to be, that is income that was paid to you. Yes, it was paid to you. It was tax-deferred. You didn't pay taxes on it, presumably if it's a traditional type of 401k. So that money is going to come out taxable in whatever bracket you happen to be in. The other one is pension. You mentioned pensions. I think some people know they're getting a pension, but for whatever reason, it seems to me that many people don't understand how pensions are taxed. Professor, they are taxed just like any other type of income.
Under almost all circumstances, a pension is a taxable event to the extent of the payment. It's just like if you were taking it from an IRA or from a 401k. It's a taxable event. There's a few small areas where a disability pension, something of that nature, could have some tax-free benefits towards it. But for the vast majority of people, if you're getting a pension, whether it's a union pension, a company pension, whatever, it's going to be taxable to you. And so that just goes on to your tax return. It's it replaces your paycheck. It's taxable just from an income standpoint, just like your paycheck. Luckily, it does not have any Social Security tax, FICA or Medicare associated with it. But it's definitely taxable.
Yeah, it's taxable at ordinary income rates. Now, there's also the Social Security that you mentioned. We've done many programs on this where we've talked about, is Social Security taxable? For some people, it's not taxable ever because of their circumstances. For others, it's not taxable for a while, and then all of a sudden they have required minimum distributions hit, and some, if not most, up to 85% of it winds up in the taxable column. And for others, they've always paid taxes on their Social Security benefits one way or another. And this is assuming, again, going forward, that they're not going to get rid of the tax
on Social Security. We'll see.
Yeah, we'll see, which would be great. But I'm going on that assumption right now. Professor, we have done, as I said, many shows on this particular topic as to whether or not Social Security is taxable. But that is something. And then when they look at their Social Security benefits online, they may not and probably won't be getting that exact amount. Would you agree?
No, I mean, it's rare. They give us whole years. So when you were looking at the projections, they tell us age 62, the month you turn 62 is if you started it on that month. Age 70, actually they go every year now, but and full retirement age, whatever your full retirement age is. But most people don't retire on that specific day, and so they retire somewhere in the middle of the year, which means it's going to be either reduced because you took it early or enhanced because you took it later than the full retirement age. So there's going to be a slight change of that. Plus, they're using the projections that they have on the books now, which don't include last year's income. It only includes 2 years ago income. So those later years' income will change it slightly as well when they actually do the hard cold calculation to it. So it's going to be close. But the cigar is just not there.
Well, and don't forget, once they hit age 65 with Social Security, the Medicare premium is going to kick in for most people. At that point, I mean, that could potentially lower your individual deposit, the amount that actually goes into your bank account, by currently a couple of $100 a month, right?
$185 for Medicare Part B and C, and if you have D, which is prescription drug, there will be a little bit more on top of that, depending upon which plan you take. And that doesn't include any supplements. That doesn't come out of your check, but the Medicare does come out of your check. I've had the question a lot too. Okay, people are coming into the age 65 zone, and they're saying, and somebody come in and say that his wife signed up for Medicare because she turned 65, but she has group, and they started billing her. She hasn't started taking her benefit yet. And he's like, why are they billing me? I said, because you signed up for Medicare. Mm-hmm. He goes, but we had to, but we only wanted A, but my wife is covered through her employment coverage, group health coverage. I said, well, then why did you sign up? He goes, well, I thought we had to at 65. If you are covered by your current employment group, and it has to be group health coverage, or your spouse's current employment group health coverage, you don't have to sign up right at 65. You can wait until you terminate employment or otherwise lose that group health coverage. And then that's your initial enrollment. And so I've had a lot of people ask me lately, so how do I go about signing up? Why are you signing up? You're still working. You're still covered by group health coverage. Did you want to switch over to Medicare? No, but I thought I had to. Yes, if you're not covered by current employment group health coverage, you have to sign up at 65. You've got the 3 months before, the month of your birthday, and the 3 months after turning 65. That's your initial enrollment period, assuming you're not working and/or assuming you're not covered by current employment health coverage. If you are covered by current employment health coverage or spousal current employment health coverage, your initial enrollment starts when you lose that coverage or you lose that employment.
Yeah,
so
and
it's just a no and win. But yeah, they're going to take money out of your check. They don't ask; they just take it. So if you were getting $2,000 a month, and Medicare premium is $185, you're going to get $1,815 a month being deposited into your checking account.
Now, for some people, that might be a good move because maybe they were paying $1,000 a month, for their group coverage or whatever it is between themselves and their spouse or whatever. So it could potentially be better, although that's not necessarily always the case. So when you look at each of these forms of income, IRAs, we'll say, traditional IRAs, not Roth, but traditional IRAs, 401ks, income from 401ks. If you have a pension, the IRAs and the 401ks will be taxed, ordinary income rates. If you have a pension, that too will be taxed at ordinary income rates. Your Social Security, depending on how much you have of those income from the 401k and the pension and all that stuff, Social Security could wind up being partially taxed or almost completely taxed, up to 85% of that. And then your Social Security payments could be reduced further by the Medicare premiums, which tend to go up now. What are they for 25? You said 185?
Yes.
Just the lowest is 185, right?
Right, that's a standard premium.
Yeah, per month per person. And who knows, next year it could be closer to 195 or 200. I don't really know. It seems to go up even more every year. But these are the kinds of things that wind up, I think, surprising people. When they do their projections, their retirement projections, I think they say, well, I've got this amount of my 401k, so I'm going to, I'll take 4% of that. And yeah, I understand that'll be taxed, but it can't be that much, and then I have my pension. I didn't know that was taxed. Oh, and Social Security, I went online and it said I'm going to get $2,000 a month. So I'm going to count on that.
Interest, people have money in bank accounts that lets them sleep really well at night. And for a long time, we didn't have to worry about paying any taxes on anything in there because we didn't earn anything on bank accounts. But lately, we've been earning 4 or 5%, 3, 4, 5% on those bank accounts. And that adds to your taxable income, whether you spend it or not. Dividends from your stock portfolio, if you have any dividends, capital gains. I've gone through a couple of this where they're selling real estate that is not their primary residence, and they're going to have a big gain. And they've heard that if your income is low enough that you've got a 0% capital gain, they think that, well, my income's low enough, I'll have a 0% capital gain on all of my capital gain. No, it doesn't work that way. Some of it, I was looking at this one case where about 5,000 of the gain was going to be in 0% tax bracket, but the rest of it was going to be in the 15. And then don't forget, there's another investment tax over. There's all kinds of taxes, But yeah, they're going to pay taxes. And so for them, because of where they were, their Social Security was already at the 85% level, so it didn't hurt them. But I've also seen where somebody who was not paying tax on their Social Security because they had decent Social Security and a little bit of IRA money, but nothing to really, trigger the big tax on Social Security, and they had a big capital gain. Well, they had a $50,000 capital gain, and that $50,000 capital gain was basically almost all in the 0% long-term capital gain bracket, but they paid a decent amount of taxes when they did their tax return. They're saying, wait a minute, my capital gain was a 0% tax. I said, yeah, but that capital gain is also part of the formula for determining the tax on your Social Security. You didn't pay tax on the capital gain, but because of the capital gain, you paid tax on 85% of your Social Security.
Yeah. One
way or another, you got hit hard.
Well, and these are the kinds of things that tend to surprise people when they wind up retiring, thinking they were going to be in the lower bracket, but they may or they may not be, depending on as we said, their other circumstances. Now, here's one other thing that may surprise people. Sometimes people who are retired, people in their 60s, let's say, they wind up with an inheritance of some kind. Some people do, and they wind up inheriting, mom and dad's IRAs.
But inherited IRAs are taxable when the money's withdrawn.
Yes, and that may be something I'd like to cover in a future episode.
Annuities. You might inherit an annuity that was not in an IRA. The gain that is in that annuity is going to be taxable to you.
Yeah.
It's still better to inherit it and pay a little taxes than, not that you want to inherit money from somebody who died, but if they're going to die anyway, you might as well get the money.
You're going to have to get it at some point, or somebody's going to have to get it. But yes, when you inherit things like traditional IRAs, 401k accounts, generally pensions aren't, unless they're set up differently. You don't have to worry so much about that. But, I think some people are of the opinion or the mind that, I once inherited somebody's personal stock portfolio. They passed away and they sent it to me, and I didn't wind up paying any taxes on it. Well, because there was on a personal portfolio what they call step up in basis. But, if you've never inherited a pre-tax account, like a 401k or a traditional IRA, Professor, there are not only taxes on that, but you're going to also have to pay. You're going to be required to take money out of it, whether you like it or not.
When you inherit a retirement account, 401k, IRA, some kind of a retirement account, and we're talking about traditional, not Roth here. And finally, they changed the rules in 2020, and they put in this new 10-year distribution rule for the majority of beneficiaries. And then in 2021, they started hemming and hawing and saying, well, this doesn't fit with previous doctrine that we've dealt with. 2022, they came out and said, well, we're going to change it, but they didn't do it. 2023, they said, we're going to change it, but they didn't make it permanent. Finally, in 2024, they made it permanent. But for those 4 years, they said, because we're kind of wishy-washy, no, this is paraphrasing, because we're just being mamby-pamby, wishy-washy, we're not going to charge anybody a penalty for missing it because we haven't stated it all the way. They finalized that in 2024, and now we know for sure what the required minimum distributions are on these accounts. And so the penalties are not going to be waived anymore. So if you have inherited an account from somebody who passed away in 2020 or later, and they were at required beginning age, you have a required minimum distribution in addition to the 10-year clock.
Yes. Now, there's a lot of complications with this and detail that we don't have time to get into. I think maybe next week I'd like to get into more of that, so we'll save some of that. But just understand that you may not. That's I hate to call it income, but it kind of is.
Oh, it is income.
It's something
It is a taxable event. Forget what do you call it, income or not? It's a taxable event when the money comes out of that IRA.
Yes,
the beneficiary IRA or your IRA.
Yeah, and it's something that you need to be aware of. So all of these things combine to, if not put you in a higher bracket, at least perhaps potentially keep you in the same bracket.
Perpetuate the bracket that you're in.
That's right. That's right. So for those who are saying, well, I'm going to be in a lower tax bracket when I retire, my response would be not so fast. Maybe, maybe not. Now, I wanted to kind of suggest there are people who say, well, maybe I can plan ahead. And you can. Maybe I can make plans. One thing that I've heard many people do is they say, well, I'm just going to retire to a tax-friendly state. I'm going to move somewhere where they don't tax income, pensions, or anything. There are, 8 or 9 states that have no state income tax?
There's 8 or 9 that have no tax on anything. And then there's like 7, 8, or 9 that have an income tax but don't tax pension income.
Yes.
And many of those don't tax IRA income either. Retirement income is basically exempt, so it comes in handy if you want to live in those states.
Well, if you want to live in those states, but remember, they need revenue somehow, and generally they're going to get you in a couple of different ways. What I've seen, personal experience, has been things like sales taxes, local taxes, municipalities, property taxes is a big one. I knew somebody who moved to Texas, I think it was Austin, and said, well, I'm moving from California to Austin, so I'm saving. And it turned out they saved maybe 1% overall once they got finished paying the property taxes and the use taxes and all that other stuff. So it's just something you need to keep in mind if you're going to do that. You may save. You probably will a little bit, but maybe not nearly as much as you thought you would. There was one state, did you know, and I didn't know this, where is it here? I think it's New Hampshire, that only taxes capital gains and dividends. Have you heard that?
I did not know that.
I got to find this here. Dang. I believe that's the case. Let me check here. Yes. Okay, so the states with no income taxes are Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, and Washington, and Wyoming. They have no tax for any of them. New Hampshire only taxes capital gains and dividend income, and federal employees in those states have no income taxes at all, so their pension isn't going to be taxed either. So I didn't know that. That's quite interesting.
But you got to live in New Hampshire.
Which
is
a
beautiful state.
Which is lovely in the fall and probably okay in the spring.
Might be a little cold, or it might have been a little cold over the last 2 months.
Could very well be. Okay, so these are things that if you want to try to plan ahead and not and try to stay in as low a bracket as you possibly can, moving to a tax-free state may not be necessarily the panacea.
I saw a study on states that are having people move out of them and states that are having people move into them. The biggest gainers, biggest losers from a percentage of population standpoint. And by and large, the states that were losing the most people as a percentage were the very high income states, New York, California, things of that nature.
Yeah.
But when I looked at the states that they were moving to, it wasn't necessarily the lowest income states. In fact, they were mostly in the 20 to 30 ranking range. They're moving out of the highest, from 40 to 50. They were moving out of those top 10 highest tax states, but they weren't moving to the lowest 10 top tax states. They were moving. Yes, Florida was in there, so yes, they're like number 2 on the list as lowest taxes. But most of them were in that 20 to 30 or 20 range. And it wasn't just the taxes. They were getting the heck out of Dodge from the taxes, but they were moving someplace with, even if they had a little bit of tax, they weren't worried, but they were going to probably where there were jobs, not for themselves, but for their kids, because people tend to move, when they decide to move, they don't necessarily move to where the kids moved. They moved to where the kids took their grandkids.
Yeah,
so,
that's it. Yeah.
So they're moving to areas that have jobs for their kids because that's where they took the grandkids. They stole the grandkids and moved away, and we're going to go live where the grandkids are.
Well, and that is tend to be what you want to be closer to family. True. Now, in the time we have left, which we only have, maybe not that much time left, Professor, can you think of anything offhand, and maybe you can, short of moving to another state, which we just mentioned has certain issues of its own? Is there anything people can do well ahead of time to potentially lower their taxes in retirement?
Well ahead of time gives you the option of doing more Roth, creating more Roth rather than more traditional, if it's an option, if you can do that. But that's one of the big areas, is having the ability. I have a client in the Bay Area of San Francisco. They have a decent pension, but they've, over the years, been able to move all of their money, their IRA money, to Roth. So anytime they want to have some extra money to do this, that, or the other thing, they don't have to worry about, oh man, if I need $20,000 for this, I got to take 30 out? No, they just take the 20 because they don't have to pay taxes on it. Mm-hmm. Everything they've got is Roth, and they're having fun with that. But it took years ahead of retirement to move it there. They didn't do it overnight, and it was something that they planned for. You can get that way after retirement, but it takes a little bit more planning, because we have to worry about where we are with conversions.
Yeah, we talked about the benefits of the Roth, but also the costs. There's a cost to get it to play. And is the cost going to be greater than the benefit? That's something that you're going to have to determine. I think the people who have the best Roth situation are the people who bought, equities or something years ago. And
right, they bought NVIDIA when it was $3 a share.
We're not recommending that. Not recommending that, folks. We're just mentioning,
because you can't buy it for that anymore.
No, you can't. But I'm saying but they got lucky and they wound up with a big capital gain, a big gain that is not going to be taxed because it's within the Roth. That's the best situation. But if you can get money into a Roth, as you said, that can be one way to plan ahead. Can you think of any others? If people say, well, Roth, it's going to do, I can do some, but it's really not going to make a huge dent. Is there anything that you can think of that may work?
I mean, other than taking less income?
Yeah.
By the time you're retired, your income and your expenses are fairly well known. Yeah. You know what your expenses are, and so you've got to cover your expenses. And where's that income going to come from? To cover the expenses, it's going to come from your Social Security. It's going to come from withdrawals from your investment portfolio. Now, if you have a large personal portfolio, we can try to tax manage in that area. But if you also have a large IRA, at some point you're going to be forced to take money out. And in many cases, it's better to take money out before you hit that magic required minimum distribution age of 73, soon to be age 75 in the future. Because if all we do is let it alone to grow until that time, the RMD may be that much larger, which may screw up all the tax on everything else I'm doing.
Well, yeah, and that is a strategy, Professor, that you can, especially if you tend to look at this a good 10 years, if not a little more, ahead of time. When you're staring down and at age 62, 63, that coming up at age 73, or at that point it'd be age 75, you've got the required minimum distributions. One of the things you can do is to try to reduce now the balance in that tax-deferred account, that IRA.
And the way to reduce the balance is either live off the money now or do conversions now. Take it out now while you're in the bracket you've got today to kind of stymie the growth of that account. And if you're taking the money out of there, that means either your personal account is not funding your income or your Roth, or money's ending up in your Roth IRA. Either way, it's a better tax situation.
Yeah, and when you say stymie the growth, I mean it's only stymie the growth of the tax deferred account. We're not
stymieing the growth of the overall net worth.
No, you can still put it inside of a Roth and potentially allow it to grow there. But that's the point, to keep the balance down in that IRA. So when the time comes at age 73, 75, and you are required to take that money out, you won't be hit so much with quite a big tax bill.
Now, we're not waffling when we say 73, 75. There is a change in the rules coming up. Anybody who turns 65 this year, who was not 65 by the end of last year, anybody who turns 65 this year or is younger, their required minimum distribution age is 75. So this is the year We're starting the 10-year clock on that. If you're already 65 by the end of last year, your required minimum distribution age is 73. But if you're 65 or younger in this year, calendar year, your required minimum distribution age is 75 until they change things again.
Which, I mean, there's no guarantees that they're not going to change them, no guarantees that they will change them. All we can do is tell you what's happening as of our recording right now. That's kind of the best thing that we can do. So there are some steps you can take. I really think the tax management of a portfolio, Professor Plum, whether you're retired or not, can ultimately potentially give you some really good benefits. I mean, in the end, we've said many, many times that taxes are the biggest, outside of perhaps of investor behavior, taxes are the next biggest drag on your portfolio's performance. And
they're an expense that we generally don't like paying. Don't get a direct benefit from it, but I mean, there are some expenses, travel and things of that nature. Yeah, we have to pay it. We don't mind it though because we're getting a direct benefit from it. Taxes are one of those ones. If we can afford to figure out a way to manage those taxes and pay just what we're legally bound to pay on an overall basis, not just 1 year at a time, but looking at it forward, and reduce that means that we either don't need to take as much out of our portfolio, we can leave more for the kids, or we can have more money, to spend on the things we really do like
vacations, food. Or visiting family, either visiting family or getting away from family. I don't know I don't know what your situation is, but hey, it's nice to have. At least it gives you some options. Tax management is one of the things that the people at Lucia Capital Group do. I personally believe they do it very well. They've had a lot of experience doing it, and I think if you want to talk more about tax managing your portfolio, if you're concerned that you may be paying more in taxes than you have to, especially in retirement, when you really could use the money yourself. Give the people at Lucia Capital Group a call. The advisors there can help you out. 800-644-1150. We thank them for being our longtime sponsor, and I mean long time. 800-644-1150, the number at Lucia Capital Group. Also go online to luciacap.com. That is spelled LUCIACAP.com. You're going to find all kinds of videos, blog posts, articles. We've also got these guides that you can download. I should mention that again. I may have I may have the Lucia Capital Group company president, Joe P. Lucia. I think you know him quite well. I may have him stop by in a couple of weeks and tell us a little bit about that. Just cool. Knock on the door. So, but anyway, that's coming up. These guides, though, these are really helpful. I believe we have a Social Security guide, which doggone it, we still got to update. We have the retirement income guide. We have a bucket strategy guide, an estate planning guide, all free. Just go to the search bar up at the top of the Lucia Cap website and type that in, bucket strategy, estate planning, retirement income, whatever it is, and that'll be the first thing that comes up. You could download it absolutely free and read it and understand some of the stuff that we talk about on this program. Again, luciacap.com. One more time, a reminder to subscribe to this podcast, Apple Podcasts, Spotify. Download every episode to your device and listen away. We always appreciate new listeners. And if you enjoy the program, you can go to luciacap.com and shoot us an email. Or if there's something you'd like us to talk about, let us know right there as well at luciacap.com. All right, we're out of time. You've got some more work to do, and we're going to get busy getting ready for the next episode. So, Professor Plum, thank you for all your wisdom. As always, I do appreciate it. I literally mean it when I say I could not do this without you.
Well, thank you, sir. I couldn't do it without you either.
Hey, you know what?
I have no idea how to push those buttons.
Perfect team, right? That's what we are. All right. For Professor Rick Plum, Certified Financial Planner Professional, I am your podcast host, Johnny Dean. Thanks for listening. This is Managing Your Financial Future. And, of course, we will talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its its accuracy cannot be guaranteed. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with investment in the shares are compatible with their investment objectives. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum and Joe P. Lucia are registered representatives with, and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.